Chapter 3: The Accounting Canvas. Paint your own picture, but remember any canvas has its boundaries. With the strong hope that the first stumbling block this subject usually faces has been cast aside, let me proceed to introduce to you the canvas that is presented by the subject on which you can paint your own picture. The accounting canvas is nothing but the following two statements that get prepared at the end of every reporting period, which could be quarterly, half-yearly, or annual in terms of its recurring frequency. The profit and loss statement and the balance sheet. It is a good idea to start deep diving the subject from this canvas, since they are the very purpose of maintaining accounting records, and the very reason why even people who do not specialize in the field of commerce want to be on top of this subject's understanding. So far, we have seen the three account types, and how they are interconnected with the rules of debit and credit. They are the pillars of the most granular item, which is a financial transaction of a business, and how it gets captured as an equation of debits and credits. However, financial statements that are periodic reports deal with cumulating those financial transactions into meaningful buckets called aggregates through which the financial performance can be easily understood and interpreted. These aggregates can be any unlimited number of them based on how a business entity wants to group its transactions to provide for meaningful reports, which can then be drilled down up to the last transaction. But the good news is that there are only 5 account categories into which these aggregates can fall under. It is enough to just understand these 5 account categories to form a correlation between the financial statements and the rules of debit and credit. The 5 account categories that eventually subsume all the financial transactions of a business entity are asset, liability, capital, expense or expenditure, income or revenue. Page 12 of 64. The following table will help you understand these 5 account categories in greater detail, so that you can visualize it from a business context with illustrations. Account category illustrative overview. Asset. An asset can be understood as the resources in the possession of the organization. The individual items in this category may vary in their attributes. Some may be physical, like plant and machinery, furniture and fittings. Some may be just notional, say goodwill or brand value, etc. Some may exist on paper, legal claims like receivables for credit sales, shareholdings, etc., that have a clearly traceable value. Some may have a very long life while others may have a very short life. Some may be non-operative in nature, as covered in the meaning of expenditure below. Liability. A liability can simply be understood as the financial obligation of a business entity, from whose perspective the accounts are maintained, to other entities, and can be illustrated as follows. Amounts payable to vendors/suppliers for credit purchases. Amounts collected as advances from customers for future delivery of goods and services. Statutory obligations like taxes which are collected and provisioned, but yet to be paid to the government. Some of these liabilities could be short-term, and some could be long-term in nature. Capital. Capital, equity and debt, is the financial source through which the organization has funded its assets. While equity is by nature long-term, and is meant to stay in the business till its entire lifespan, debt can be long-term as well as short-term, as explained in the first chapter itself. Short-term debt is typically provided by banks, and is also known as financing the gap of short-term assets being greater than the short-term liabilities. An optimal mixture of them should be employed. The optimal ratio of equity to debt varies by industry. Expense or expenditure. Expense relates to costs incurred in the conduct of normal business operations within the scope of a reporting period. Expenditure differs from expense to the extent of being relevant for more than one reporting period. The portion of an expenditure, which is written off against the income of a reporting period, is said to be expensed or amortized in that period. The portion of the expenditure, which is not yet expensed in any accounting period, is to be viewed as an asset, that is, a notional or intangible asset like goodwill. Page 13 of 64. Let us take an example of an expenditure that gets expensed over a set of reporting periods. An international company is foraying into a new country and sets up a local company in that country. Let us further assume that its marketing campaign in the first year involves a huge brand building effort, and the company hopes to derive its benefit over the next 5 years. The money spent entirely happens in the first year and is termed as the expenditure. The amount that is written off, proportionally or otherwise based on management discretion or any applicable statute, in each reporting period is to be understood as the expense for that reporting period. The balance not yet written off is to be viewed as a notional asset. Income or revenue. Income is a more encompassing term and consists of revenue within its scope. Revenue relates only to earnings arising out of normal business operations. Income also includes non-operating gains like financial profits generated out of, say, treasury management, or on sale of assets/scrap, or interest income generated from bank deposits, etc. To summarize, any business can be viewed as an organic entity, which puts in place the necessary resources, long-term assets, using an optimum mixture of the equity and long-term debt, capital, to carry on its business in the process of which it generates income/revenue and incurs expense/expenditure. To carry on this process smoothly without friction, the business entity needs working capital, short-term liabilities in excess of short-term assets. And to tide over any shortfall in such working capital, short-term assets being in excess of short-term liabilities, popularly known as working capital gap, it typically needs a bank financing in the form of current account overdraft facilities, short-term debt. The excess of income over expense that the organization achieves in a defined reporting period is called profit, or operating surplus, which can further be understood as the return that the stakeholders providing the capital, equity, and long-term debt share among themselves. It is in sharing these returns that the stakeholders in equity and debt differ. Debt must be serviced at defined rates and at a defined frequency, whether there is an operating surplus generated by the business entity or not. Equity can be serviced only out of a net surplus that remains after debt is serviced by interest payments, and further after paying taxes on the resultant surplus, if any. This can also be perceived as the reason why equity capital providers are viewed as the owners of the assets, while lenders of debt capital have only a supervisory claim on it. Now that we have understood the meaning of each account category, we will now plot their positioning in the final statements. Page 14 of 64. The profit and loss statement, typical structure. Debits. Expenses. Direct expenses. Gross purchases. Material consumption. Trade discounts given. Others. Overheads. Manufacturing or operations. Marketing. Selling and distribution. Corporate or administration. Employee. Financial. Profit. Credits. Income. Revenue. Gross sales from products. Gross sales from services. Trade discounts received. Others. Other income. Gain on sales of scrap or assets. Forex or treasury gains. Interest income. Others. Loss. The balance sheet, typical structure. Source of funds. Capital. Equity. Long-term debt. Short-term debt. Bank overdraft. Short-term loans. Others. Liability. Long-term. Accumulated taxes. Short-term. Current year taxes. Payables to employees. Payables to suppliers. Customer advances. Others. Profit. Application of funds. Assets. Tangible. Long-term. Land and buildings. Plant and machinery. Furniture and fittings. Others. Short-term. Cash. Bank balance. Receivables from customers. Advances paid to suppliers. Others. Intangible. Goodwill. Patents and trademarks. Capital expenditure not yet written off. Others. Loss. If in the profit and loss statement you have spotted that profit and loss seem to be appearing wrongly under expenses and income, then do not worry, it only means you are paying good attention. Page 15 of 64. The profit and loss statement shown here is only for its typical structure, and hence represents profit and loss as balancing figures. In other words, they appear in the side opposite to the side that has a higher total. This is also the way the ledger of any account will look like. You will learn more on ledger view of representing an account in Chapter 5. However, to appreciate profit and loss representation in the structure of the balance sheet, a fundamental aspect about it must be made explicit. The balance sheet is a statement about the business acting as a separate entity. For a company, this concept is very clear as law incorporates it as a separate legal entity. But from the accounting standpoint, all forms of businesses are viewed only as entities, having an identity separate from that of its owners. Even in the case of partnership or sole proprietorship. Once this is clearly understood, it would take very little time to appreciate the following discussion. Liability is something that is owed by the business entity back to its providers. Hence, even capital is to be viewed as owed by the business to its owners, except that it is owed at the time of liquidation/closure of the business. Asset is something that the business entity either possesses, physical or intangible assets, or is owed to it by other entities, claims, etc. Now, profit is something that a business owes to its stakeholders of equity capital, and can be intuitively understood as a liability. However, loss can be understood as an asset in two ways. Either as something that is owed to the business entity by the stakeholders of equity capital, since they are the people who run the show, directly in case of partnerships or proprietary concerns, and through representatives in the case of a company, for having run the affairs of the entity in a manner culminating in a loss. Or as something that goes towards reducing the liability of the business entity towards its equity capital providers, because in the event of liquidation the entity need not pay back to the extent of loss. If you feel that this is a fatalistic way of viewing any business, you are free to adopt the first approach. You would perhaps appreciate the fact that the items indicated in bold blue letters in the profit and loss and balance sheet statements are just about the 5 exhaustive account categories with which we started this chapter. In other words, we have covered their meaning and how they get their expression in the final accounts of a business entity. It is high time to give a link between the rules of debit and credit and the account categories. This will be done by establishing the link between account categories and account types, since the accounting rules are defined only for account types. We will understand these linkages in the next chapter.